My name is David Lee Jones. I am the fifth generation here on this farm. It is situated alongside the Rangitikei River, east of Martin. It is low-lying river flats, river terraces. We have a total of about 164 hectares here, with 130 hectares of arable land and some hillsides. Currently, we are from our income is about half arable cropping and about half from livestock. We finish both lambs and cattle, and we don't have a breeding flock either of beef or sheep anymore. So the original settler here was Edwin Toms, and he was an engineer who built bridges. So he helped the farmers in the region connect their farms up and build roads and build bridges. And he started with a small piece of land here, and he, over his lifetime and the next generation, they extended it out to about 160 odd hectares. So that's what we're farming now. So my background is that I was brought up here and always just loved getting out on the farm with my dad, and we were always interested in kind of outdoor activities like horse riding and that sort of thing, doing stuff on the farm. So I completed a farm management and economics degree at Lincoln in 1982, and after about a year and a half doing a bit of an OE, I came back here and divided my time between trying to be an equestrian and following in Mark Todd's footsteps, which I realised I was never going to be able to do. But I also took a job sort of 3/4 time with a local accountancy business that had 4 partners, and roughly half, if not 60% of their clients were farmers. And so it was the 1980s, and we had the end of the Muldoon government and the Longy Douglas government, which was an incredible reforming, transformative government. So they rolled back all the subsidies which had built up since the 60s, and kind of capped off with Muldoon's land encouragement loans and livestock incentive scheme, and Roger Douglas brought in the kind of idea of monetary policy to control inflation, and we saw interest rates go up by the late 80s to anywhere from 20 to 30%. So people who at the start of the 80s had been paying 4, 5, 6%, suddenly over a period of years they were paying up to 20, 25%, in some cases higher. So against that backdrop, we were producing meat that there was no home for, and the prices for meat fell to incredible lows. So there was a fair bit of work with an accountancy partnership, just doing budgeting, helping guys out with budgeting and trying to make sure we could see that they could make ends meet. And the one thing that kind of struck me throughout that time was a lot of owner-operator farms survived by their wives going out to work. So that was a real transformation from the 40s, 50s and 60s, where most farmers' wives would stay at home. Around here it's flip-flopped totally in the 80s to where most farmers' wives would go out and work just to make enough money to pay for the groceries, essentially. So that, and bearing in mind that this district, the Rangitikei, was probably one of the most least affected in that economic downturn for farming as anywhere in New Zealand. So it had generally low debt levels, and most farmers were reasonably well shielded from the extremely high debt burdens, but we did see it. It started the transformation of land use in New Zealand, which can be shown just on this road here. Our little back road, it was essentially all sheep back in the 1980s, and quite a bit of barley and wheat cropping, and a few cattle. Now we are the last sheep farmer on the road, and we don't have a ewe flock anymore, and it's virtually all either beef production, dairy support, or dairy farming now. So that's a kind of microcosm of what happened throughout New Zealand on the good land that was suitable for intensifying to dairy. The big driver to change in land use was profitability, essentially. Dairying became a lot more profitable than sheep farming. And we had, while through the 80s we had good profitability from arable, that faded during the 1990s. So the kind of arable sheep combo just wasn't as profitable. So dairying moved into wherever it was suitable, and dairy support, so grazing heifers off the dairy platform, became a more profitable and more reliable source of income than cropping and finishing sheep. In terms of the effects, one of the things I noticed when I was first back here in the 1980s with a bit more knowledge was essentially farmers around this district never put enough fertiliser on because they just had run out of money, and there wasn't a good rotational grazing animal for grazing sheep. People generally around this area didn't rotationally graze their sheep very well to be able to allow the pastures to flourish. They overgrazed at the wrong time of the year. That typically we got summer dry for a month or two. The pastures would be overgrazed. That would then open them up to for thistles to grow, and then they wouldn't. And then there was a lot of so when it did grow again, they typically stopped during the winter again. So the change to cattle, people did start to do more rotational grazing, which was better for getting a better sward, and typically use more fertiliser. And the other thing that changed post the 1980s was during the 70s and 80s, we knew there were pests and diseases which affected ryegrass especially. So Argentine stem weevil affected longevity of ryegrass stands. We knew that high endophyte ryegrasses with the high endophyte fungus in them would repel Argentine stem weevil, but the side effects from that were ryegrass staggers and heat stress in the stock. During the late 80s and going into the 90s, new endophyte safe ryegrass species cultivars were released, and that pretty much overcame the ryegrass staggers and heat stress. So we were able to get more productivity from the grasses, especially through the autumn, better animal production. So that combination meant pastures probably looked a lot better, more fertiliser, a new species, better grazing management, and that's what the kind of land use change brought in. Dairying in the Martin area never really took off like it took off in Canterbury or Southland. I think it was just around actual Martin Township, it was just too wet. Where dairying has sort of where we've changed to land use changes, for instance, farms like ours that are generally free draining and along the rivers. So we've got free draining, access to water for irrigation perhaps, they change to dairying. Whereas around Martin, people change to lamb finishing and to dairy support. So in terms of the issues, profitability is always an issue. So that's the price of land is always too high for the return. So that's just a perennial issue. In terms of, I guess, where people are now is the kind of there's a bit of dread or a bit of anxiety over what's coming next in terms of environmental issues, and we're in the Horizons regional region area. We are not in the red zone special nitrogen area here, but there's a border only sort of a K away from us to the southwest. So and that so that in those areas, if you're dairying, requires a reduction to your nitrate leaching. I'm not I fay with the exact numbers, but so that type of thing is probably going to extend out over time, depending on trends in the waterways. The other thing is that people will be wondering how the climate change response is going to affect farming and what will actually happen. Will we be paying a tax? Will we, just how it all works. And this region, all these farms through here will be affected just like everyone else will be. So that's something coming down the pike at us, and I think most farmers are not really aware of the potential costs. Covering off on the negatives are nitrate and phosphate leaching externalities, which we're all, right down to this farm, are going to have to address over the next 10 years, 5 to 10 years. And the climate change response is the other potentially negative factor. There's a huge suite now of measures that we can take, ranging from some interventions. So in terms of nitrate leaching, there's some technology that's coming that can help in terms of nitrate inhibitors, a new suite of nitrate inhibitors that we can spray on the pastures or target using sensors that can target dung and urine patches. We can use, so there is potentially, and it's not well understood, but using some of these sort of regenerative grazing techniques, if we can grow the organic matter and the carbon in the soil, we will have potentially a positive effect on slowing down leaching, and we could, if we can sequester carbon into the soil and show that it's permanent, that will help offset some of the emissions from, or could potentially offset nearly all the emissions of methane and N2O. The other thing in terms of CO2 or equivalent emissions is above ground sequestration in terms of growing trees, and even on this farm we could look at growing some indigenous species, and there's potentially land close to here, right in this district, that could benefit from exotic forestry perhaps to sequester carbon. So there's potentially available in the emissions trading scheme post at this stage, post 1990 forests, and they have to be a certain size and a certain height, can claim carbon credits, and at the moment they're worth close to $40 a tonne, and a forest can sequester 800 to 1,000 tonnes. So there's $30,000 to $40,000 of credits that can be obtained, and we don't know how far that's going to go. So some farms will be able to offset with the use of forestry. Where some of the work that's going on at a policy level is to see if other trees and shelter belts and scrubland or hedgerows can be used to can be counted towards carbon sequestration. So we were awaiting the result of the He Waka Eki Noa process to see whether that can be used as part of our offset for the animal emissions. 2008, I took a job working for the Foreign Agricultural Service, which is part of the United States Department of Agriculture. It just turned out that at that point we had relinquished a lease on a farm which kind of halved our stock numbers. So at that point we were both looking around, my wife and I were looking around for something that we thought we could do, and this job popped up and I got it, which was a bit of a fluke. So the role so the Foreign Agricultural Service has two kind of roles around at various posts in something like 90 different countries. My role is involved with analysis of the host country's agricultural systems and reporting on the main commodities produced, which that information is mostly in a series of prescribed reports which go back to Washington, and the analysts in Washington build up from those reports from around the world and other analysis that they do a picture of world supply and demand for all the commodities, essentially soft commodities which are traded. The most well known are the grain reports, which come out once a month and are used by grain traders all around the world for trading of grain and trading of grain futures. So in New Zealand, the other side of the work that Foreign Ag Service does is in promoting and enabling American food products to be imported into the host country. So it's promotion of food products and work with market access. So my role, as I said, is in the commodity analysis, and that's given me kind of a real insight as to the changes that have happened in New Zealand agriculture since 1990. So I've watched the dairy industry not quite double since 2008, but in terms of production, it just about has. So it was a huge surge in production that really wasn't matched anywhere else in the world, and that's peaked out now. But cow numbers have dropped off, but we're still producing more milk, a little bit more milk every year, essentially. Beef production, we've got less beef animals in New Zealand than we had in 1990, but we produce significantly more beef than we did in 1990. We have less than, we're sitting at less than half the number of sheep, but we produce just under the same amount of sheep meat as we did back in 1990. So the productivity gains in the animal industries have been huge since 1990. Alongside that, we've had a real growth in the forestry sector. We're producing a lot more wood than we did back in 1990, albeit most of it is being exported in the raw log form, essentially to China. The other big growth industries since 2005 have been deciduous fruit. Apples have really, the land area that they occupy is still slightly less for apples than there was in about 2000, but we produce significantly more apple exports than we did then. The same with the wine industry. The wine industry has grown from virtually zero exports back in 1990 to over $2 billion worth of exports now. And the land area is something like 35,000 hectares of grapes now throughout the country. And the other big one, of course, is Kiwifruit, which grew significantly during the 1980s, had a huge downturn sort of mid-90s. Industry restructured itself. It is virtually the only sector that has an export monopoly of virtually any ag sector left in the world. So we have a law that enables Zespri to be essentially the sole exporter outside of Australia for kiwifruit around the world, which has in fact benefited the industry and enabled it to grow and become what it is today. So in terms of industry or commodity structures, the sheep meat never really had an export monopoly. It tried it, lasted about 18 months and failed in the early 80s. However, the Dairy Board, which had been around since the 60s, it was the sole exporter of dairy products, and it would manage the supply of the individual products through the cooperatives that were regionally based, and there were 20 or 30 of them in the early 90s. That became during the 90s was quite an upheaval in terms of government, the way government viewed regulation in the primary sector, and both the Labour government of the 80s and then the National government in the 90s were bound to try to deregulate all the sectors. And at the same time, the dairy industry went from 20 or 30 odd smaller cooperatives. The cooperatives amalgamated and took over each other until we had two cooperatives left at the end of the 1990s, Kiwi and the New Zealand Dairy Group. The negotiations with the government ended up with Kiwi and NZDG amalgamating, and essentially the Dairy Board was deregulated so that at 1999 anyone could then export dairy products, and essentially the assets and the workforce of the Dairy Board were wound into what became Fonterra, which was Dairy Group and Kiwi when they amalgamated. So the only two cooperatives that were left outside this huge new entity were Tatua, which only has about 120 suppliers, and Westland, which wasn't that much bigger. So that brought in the new era of dairy farming in New Zealand. Now the industry from at that point, it was already growing quickly during the 1990s, but 2000 to 2015 was huge growth. The industry was deregulated. You had at the start, Fonterra was about 96% of the industry, picking up about 96% of the milk. They are now down to about 81% of the milk that they process, and there's been new players come in. The most notable of these is Open Country, which is just a straight commercial player, and Synlait again, which is a commercial player. Westland has been taken over by a Chinese company, and they are now pretty much a straight commercial entity. The only cooperative that's left outside of Fonterra is in fact Tatua. The other industries have gone through deregulation as well. The apple industry was run, all the exports were handled by the Apple and Pear Board. That was deregulated in about the same time, 1999-2000. It wasn't as smooth a sailing for the pipfruit sector, in that they ended up in a short period with far too many exporters and discounting the fruit offshore, and highly reliant on the European and British markets. Interestingly, that sector has now has reorganised itself down to a lot less exporters. The exporters are integrated back through the pack sheds and onto the orchards. The industry has had a remarkable transformation to growing virtually nearly all the apples that are grown now are grown to market demand. So there's been a lot of replanting since the year 2000. Only something like 16 or 17% now of the apples grown are Braeburn, which was the major variety back in 2000. Zespri, as I indicated, is the only one that has gone toward a kind of industry monopoly. All the other sectors have been deregulated and have gone away from that kind of model. in the future, it is very unlikely there will be there'll be legislation that enables a monopoly. We do have the Commodity Levies Act, which if an industry has enough, if the industry support is such, they can charge a levy which becomes compulsory for any purpose they like, but the purpose has to be shown first and then it's voted on. So for example, the beef and lamb sectors have a commodity levy for research and development and marketing, and that's what funds Beef and Lamb New Zealand. Dairy NZ is funded on the same basis, and it doesn't do any marketing, but it's behind the farm gate science and industry good work. Now, you could use the Commodity Levies Act to form some sort of a marketing entity and use a levy to fund marketing activities, but you need to get something like 60 to 75% industry support to be able to get a levy in place or a new entity in place. So I don't see a monopoly being enabled like Zespri again. There's more likely to be this sort of co-opetition type arrangement where that's kind of prevalent in the apple industry, where big operators don't impinge on each other in terms of trying to undercut once one player has say a string of supermarkets that it's supplying, another operator doesn't come in and try and undercut that to grab that business. Now that is not such a it isn't done like it was. In terms of our exports, deregulation has had mixed blessings in that sure, we got more efficient onshore, but if you've got many sellers all trying for the same market offshore, the usual result was lower prices back to New Zealand. So, and that was very prevalent in the apple industry during the 2000 to 2010. It has been very prevalent in the meat industry up until probably 5 or 6 years ago. The dairy industry has probably escaped that issue, even though we now have several alternative strong players who are exporters outside of Fonterra. Fonterra still controls 80% of the milk and is still a world leading exporter. And so the issue's probably it's not. Everyone always says that they never sell their whole milk powder, for example, less than Fonterra's auction price. And so the Global Dairy Trade Auction, which is every second week, auctions whole milk powder, and the companies always say that they never sell for less than that. So there has been an issue with, once you do away with your marketing monopoly, you do open yourself up for being played in the market and getting lower prices. And you could see it happening very quickly in the kiwifruit sector if they did open up, because there is only gold and green. There's only two products. The most valuable market is Japan, and a couple of the big players would just go direct to Japan, undercut Zespri to grab some market share, and that would kind of the ability to manage the supply into that market for the maximum return would be lost. So the Apple one is different now because there's so many different types, varieties of apple now, that you can build up your own little niche around your apple and you try to get a premium for it. The sort of monopoly type enabled monopoly exporter is probably a thing of the past, and we will hang on to Zespri because it's particularly successful. Fonterra, interestingly, it was losing market share up until about a year ago. It's actually, despite what commentators say, it's performing really well at the moment, and I think they are very focused now on maintaining their market share. So I suspect that the kind of boom days of smaller dairy factories starting up are gone for the present, and Fonterra's market share will probably hold at roughly that 80% mark, which gives it a pretty powerful platform to be successful as both a commodity player and a niche value add player, or a smaller value add player. So looking forward, the meat industry is probably sort of halfway between, in that it's looking to what could be seen as advantages of meat production in New Zealand, which is essentially grass-fed. So that has some resonance among certain consumers, and they are willing, in some cases, to pay a bit of a premium for that meat. So there's a lot of work going on now to kind of determine what are the things that those, what do they call them, conscious consumers, or what they will actually value and what they'll actually pay more for. So is it the kind of story that goes with it? Is it the assurance that we can give that it doesn't have antibiotics, it's pasture fed and has good animal welfare characteristics? So so essentially, outside of whole milk powder and skim milk powder, most of the rest of the products, meat, fruit, are all looking at selling to the most affluent consumers in the world, wherever they are, whether they're in Asia, whether they're in Europe, United States. So we're trying to work out how we extract a premium from those markets. Is it taste? Is it the sustainable growing methods? Is it free froms? The sort of free from GM, free from antibiotics, pasture fed. So that, now whether that actually is an actual premium, or whether these things just make sure we're still in the market, we can still play, we can still send our stuff to the richest markets in the world. That remains to be seen, because once you've got manufacturing beef of 70% chemical lean, it ain't really much different to Brazilian or Argentinian, and so the traders around the world are not that prepared to pay much more for a New Zealand beef. So we do have to work out, it's ongoing and it's difficult to try and differentiate.